Most people think a war in the Middle East is a foreign policy story. They are wrong. The U.S.-Israeli military operation against Iran that launched on February 28 of this year is currently functioning as the single most powerful force acting on the U.S. housing market. Not the Federal Reserve's rate decisions. Not the inflation data that gets released each month and moves markets for a day before being forgotten. Not the 3-year-long debate about housing inventory. The war. Here is the mechanism that most homebuyers and most real estate coverage is not clearly connecting. The strikes, codenamed Operation Epic Fury, effectively closed the Strait of Hormuz. The strait is the narrow waterway through which roughly 1/5 of the entire world's oil supply passes every single day. When military activity made that passage untenable for oil tankers, the global oil supply contracted by approximately 20% almost overnight. Oil markets responded immediately. Energy inflation began building. And energy inflation feeds directly into the bond market dynamics that determine where mortgage rates price. The 30-year fixed mortgage rate was 5.99% the day before the strikes. It is now at 6.46%. 5 consecutive weeks of increases. On a $450,000 home with 20% down, a buyer who locked their rate 1 month before the strikes would pay more than $33,000 less over the life of their loan than someone securing a rate today. That is not a rounding error. That is a meaningful deterioration in purchasing power that has occurred not because of anything happening inside the U.S. economy, but because of a military decision made in Washington whose housing market consequences were not part of the public conversation when it was made. The spring buying season that every major real estate platform, every mortgage lender, and every housing economist had projected as the turning point for American homebuyers after 3 years of near-frozen market conditions has been effectively derailed. The mechanism that derailed it runs from the Strait of Hormuz to the oil market to inflation expectations to the bond market to your mortgage payment. And understanding that chain is not just analytically interesting. It is financially urgent for every American currently making a housing decision. The hidden consequence. There is a consequence of the Iran conflict on the U.S. housing market that is less visible than the mortgage rate increase but potentially more durable in its effect. It involves the specific segment of the market that was supposed to provide relief to homebuyers who have been locked out for the past 3 years. I will identify it precisely later in this breakdown. But understand that the mortgage rate increase is the headline story. What is happening beneath it may be the more consequential development for where U.S. home prices go in the second half of this year. The causal chain. How a war 7,000 miles away moves your mortgage rate. The transmission from Middle East military conflict to U.S. mortgage rates is not new. It has operated in every major energy-disrupting geopolitical event of the past 50 years. But most Americans have never had it explained to them clearly, and that gap in understanding is part of why the current market reaction is catching so many buyers off guard. It starts with oil. The Strait of Hormuz is the world's most critical energy choke point. Approximately 20 million barrels of oil transit it daily, representing close to 20% of total global petroleum consumption. When the U.S.-Israeli strikes on Iran began and military activity made strait transit dangerous for commercial tankers, the oil that normally flows through that channel stopped flowing. The International Energy Agency described the resulting situation as the greatest global energy security challenge in history. Here is something most people completely overlook. The United States is now a major oil producer. America's domestic shale production has transformed the country from an oil importer to one of the world's largest producers. You might expect that to insulate U.S. consumers from a Middle East supply disruption. It does not. And this is what I was pointing toward when I said the chain from the strait to your mortgage is less obvious than it appears. The reason is that U.S. domestic oil production is now deeply integrated with global markets through the infrastructure built over the past decade to facilitate exports. U.S. oil prices are set by global benchmarks. When global supply contracts, U.S. prices rise alongside global prices regardless of domestic production levels. Higher oil prices produce energy inflation. Gasoline crossed $4 per gallon for the first time since 2022 in the weeks following the strikes. But the inflationary effect of an oil shock does not stay contained in energy prices. It spreads through the cost structure of the entire economy. Transportation costs rise, raising the price of every good that moves on a truck or a ship. Manufacturing input costs rise for any process that uses energy. And consumer confidence deteriorates as households see their discretionary spending compressed by higher fuel bills. The Federal Reserve's response to this inflationary pressure is the critical link in the chain to mortgage rates. The Fed had been on a trajectory toward additional rate cuts in the first half of this year, based on the inflation trajectory that prevailed before the strikes. The energy inflation introduced by the oil shock has disrupted that trajectory. Markets are now pricing in a significantly reduced probability of near-term Fed rate cuts, and in some scenarios, an increased probability that the Fed holds rates higher for longer than its pre-conflict guidance suggested. The Fed was supposed to cut rates this year. The Iran conflict may have just taken those cuts off the table. Mortgage rates do not move directly with the Federal Reserve's policy rate. They move with the yield on the 10-year U.S. Treasury note. And the 10-year yield has been climbing since the strikes began as bond market investors price in the inflationary consequences of the oil shock and reduce their demand for long-duration bonds at current yield levels. When bond prices fall, yields rise. When the 10-year yield rises, mortgage rates follow. The 10-year Treasury yield hit its highest level since July of last year in the weeks following Operation Epic Fury. That is the direct mechanical link between a military operation in the Persian Gulf and the mortgage rate quoted to an American homebuyer in Dallas or Denver or Detroit. The mechanism is now clear. But the housing market consequences go beyond the mortgage rate increase itself. What is happening to new construction, to buyer behavior, and to the specific market segments that were supposed to provide the inventory relief that American buyers have been waiting years for is where the story becomes most consequential. And this is where most investors and buyers get caught. The spring market that was supposed to change everything. The 2026 spring housing market had been the most anticipated turning point in American real estate in 3 years. The logic was straightforward and the data supported it. Mortgage rates had been declining from their peak levels. Inventory was gradually improving. Homebuilders had been ramping up production. And the pent-up buyer demand that had accumulated through 3 years of near-frozen market conditions was estimated at between 4 and 5 million qualified households waiting for conditions to improve sufficiently to justify entering. Zillow had forecast a 4.3% gain in existing home sales for the full year. The Mortgage Bankers Association had projected meaningful improvement in purchase application volumes. And major homebuilders had been providing forward guidance consistent with a market that was finally absorbing the buyer demand that had been building on the sidelines. This is what I was referring to earlier when I said the hidden consequence below the mortgage rate headline may be more durable. The spring market was the release valve for years of compressed demand. When that release valve fails to open, the compressed demand does not disappear. It accumulates further. And the longer it accumulates without a release, the more volatile the eventual release becomes. Whether that volatility manifests as a sudden surge in activity if rates decline or as a prolonged period of continued transaction suppression if the conflict keeps rates elevated is the most important unresolved question in U.S. housing right now. The current data shows the valve failing to open. Mortgage applications dropped more than 10% in the week following the sharpest rate increase since the conflict began. KB Home, one of the largest publicly traded home builders in the United States, lowered its full-year forecast and cited the conflict directly. The company's chairman stated on an analyst call that consumers have been faced with a variety of challenges, and the conflict in the Middle East has added another layer of uncertainty that is weighing on purchase decisions. A CNBC survey of real estate agents found that concern about the broader economy and borrowing costs has overtaken home price levels as buyers' primary worry for the first time in several years. Here is what nobody tells you. When buyer sentiment turns this cautious this quickly, even a subsequent rate decrease does not immediately restore the activity level that existed before the confidence break. The behavioral economics of housing purchase decisions are not purely mechanical. They do not simply follow the rate level up and down in a linear relationship. When a significant uncertainty event, a military conflict, a financial crisis, a major policy shock, disrupts the confidence of buyers who are already operating at the edge of their affordability, many of those buyers do not re-enter the market the moment the triggering uncertainty resolves. They wait for an extended period of demonstrated stability before recommitting to a decision of that financial magnitude. The 2022 rate shock demonstrated this dynamic. Even after rates stabilized, the buyer activity that had been disrupted did not fully recover for months. The Iran conflict is introducing the same psychological dynamic into a market that was just beginning to emerge from the previous confidence disruption. What history says about oil shock housing markets. The relationship between major Middle East energy disruptions and U.S. housing market performance has a documented historical record that provides context for what the current cycle is likely to produce. The 1973 oil embargo produced the most severe energy-driven housing market disruption in modern American history. Mortgage rates, which had been in the 7 to 8% range before the embargo, climbed steadily through the 1970s as energy-driven inflation became embedded in the broader price level. By 1981, the 30-year fixed rate hit an average of more than 18%. The home ownership rate declined over this period as the financing cost of purchase became prohibitive for a growing share of potential buyers. The housing market did not fully recover its transactional health until rates came down substantially in the mid-1980s, more than a decade after the initial oil shock. The 1990 Gulf War produced a more contained but still meaningful housing market impact. Rates spiked temporarily on the initial invasion news before moderating as the conflict resolved faster than many market participants had anticipated. The lesson from that cycle was that the duration of energy market disruption is the primary determinant of how deeply the shock penetrates into the mortgage rate and housing market dynamics. A conflict that resolves quickly allows rates to retrace. A conflict that sustains energy market disruption over an extended period allows the inflationary consequences to become embedded in expectations in ways that take considerably longer to unwind. This is exactly why it matters that the Strait of Hormuz situation, not just the immediate military strikes, is the central variable to track in the current cycle. If the strait reopens to normal commercial traffic in a relatively short time frame, the oil supply disruption is temporary and the inflationary pressure it has introduced into the U.S. economy is manageable. If the strait remains effectively closed or operates at significantly reduced capacity for an extended period, the inflationary pressure becomes structural rather than transitory. And the Federal Reserve's response to that structural pressure is what determines whether the $33,000 mortgage cost increase that American buyers are currently experiencing is a temporary headwind or a durable new baseline. The duration of the strait disruption is the single variable that determines how bad this gets for U.S. homebuyers. The 2022 Russia-Ukraine conflict provides the most recent comparable energy shock, and its housing market consequences are instructive for the current cycle. The energy price spike that followed the invasion contributed to the inflation surge that prompted the Federal Reserve's aggressive rate hiking cycle. That rate hiking cycle took the 30-year fixed mortgage rate from approximately 3% to above 7% in under 18 months. Producing the sharpest affordability deterioration in American housing history and the lowest transaction volumes in 30 years. The current conflict is not starting from the same rate baseline, but it is introducing energy inflationary pressure into a housing market that has not recovered from the affordability damage the previous shock produced. The marginal impact of additional rate increases on a market already stretched to its affordability limits is larger than it would be in a market with more financial slack. What smart money is doing. There is a specific repositioning happening in the institutional real estate market in response to the conflict that has direct implications for the individual homebuyer and investor trying to navigate this environment. It is not the repositioning most people would predict, and it involves a segment of the market that has not been part of the mainstream housing conversation, but that is now becoming relevant in ways that will affect price dynamics in specific market categories over the next 12 to 18 months. How informed capital is repositioning right now. The institutional and sophisticated investor response to the Iran conflict's housing market impact has three observable components that individual buyers and investors can use as reference points for their own positioning decisions. The first component is the accelerated timeline on rate lock decisions. Professional real estate investors and active buyers who were already in contract or in late-stage negotiation when the conflict began moved aggressively to lock their mortgage rates in the first days following the strikes, before the full extent of the rate increase had materialized. The buyers who hesitated, waiting to see whether rates would pull back on news of ceasefire negotiations or conflict resolution, paid the cost of that hesitation in basis points that accumulated over the 5 consecutive weeks of rate increases that followed. The lesson is not that rates will continue rising indefinitely. It is that in a geopolitical uncertainty environment, the cost of waiting for clarity is a rate premium that accumulates daily. The second component is the strategic preference for adjustable rate structures in specific scenarios. Fixed-rate mortgages make financial sense when rates are expected to remain elevated for an extended period. But in a scenario where the Iran conflict resolves more quickly than current market pricing implies, and where the Federal Reserve returns to a rate-cutting trajectory as energy inflation pressure subsides, the buyers who locked 30-year fixed rates at current elevated levels will hold above-market debt costs until they refinance. Buyers who are confident in their financial stability and who believe the conflict will resolve on a shorter timeline are in some cases choosing adjustable rate structures that give them automatic rate relief if the conflict-driven rate premium dissipates without requiring the transaction cost of a full refinance. This is what I was pointing toward when I described the hidden consequence beneath the mortgage rate headline. The adjustable rate mortgage share of total originations, which had been at historically low levels while rates were elevated and borrowers sought fixed-rate certainty, is beginning to rise again as sophisticated buyers recognize the potential for rate relief in a conflict resolution scenario. If this pattern continues, it is a signal that a meaningful share of informed market participants believes the current rate level is temporary rather than structural. That belief, if it proves correct, would support the housing market recovery scenario on a shorter timeline than the current rate level implies. If it proves incorrect, the borrowers who made that bet will face payment adjustments in a higher-for-longer rate environment. The third component is the geographic reallocation toward markets with lower exposure to the specific economic vulnerabilities that the Iran conflict is amplifying. Markets with high concentrations of employment in transportation-dependent industries, energy-intensive manufacturing, and discretionary consumer services are seeing increased caution from investors who recognize that the economic impact of the oil shock will be unevenly distributed across industries and geographies. Markets with diversified employment bases, strong public sector presence, and lower commute dependency are attracting relative preference from buyers seeking to minimize the correlation between their housing market exposure and the broader economic vulnerabilities the conflict is introducing. The strategic framework for home buyers and investors in the current environment. The Iran conflict has introduced a specific type of uncertainty into the U.S. housing market that requires a different analytical response than either the standard rate environment analysis or the standard supply-demand analysis that most market commentary applies. Geopolitical uncertainty has a characteristic that distinguishes it from the economic uncertainties that housing markets normally navigate. It can resolve rapidly and without gradual warning. A ceasefire agreement, a diplomatic intervention, or a military development that allows the Strait of Hormuz to reopen to commercial traffic could remove the primary source of energy inflationary pressure from the equation in a matter of days. The bond market would respond, yields would decline, and mortgage rates would begin retracing toward their pre-conflict levels on a timeline measured in weeks rather than months. This is where things shift. Geopolitical uncertainty cuts both ways. The same mechanism that pushed rates up can pull them back down quickly if the conflict dynamics change. For buyers who are currently on the sideline waiting for clarity, the strategic question is not whether to wait for conflict resolution before purchasing. It is whether the specific property opportunity available to them today, at current prices and current rates, produces a financial outcome that is acceptable across the full range of rate scenarios that the current uncertainty implies. If the answer is yes under current rates and considerably better under lower rates, the decision to proceed has asymmetric upside. If the answer is no at current rates and only acceptable under significantly lower rates, the buyer is making a bet on conflict resolution timing that may or may not pay off within their decision window. For current homeowners in markets exposed to the economic vulnerabilities the oil shock is amplifying, the strategic priority is the liquidity audit that we have discussed in multiple contexts throughout this channel. How many months of carrying costs can you sustain from accessible liquid resources if your primary income is disrupted by the economic consequences of an extended conflict? The oil shock's transmission through transportation, manufacturing, and consumer spending creates employment vulnerabilities in specific sectors that may not be visible in the current employment data but that are building in the forward-looking indicators. Owners in exposed sectors with thin liquidity buffers are carrying more risk than the current stability of their housing market position suggests. The closing. What this moment actually means. The U.S. housing market has been shaped by geopolitical energy shocks before. Every time, the buyers and investors who navigated the transition most successfully were the ones who understood the causal mechanism clearly, who tracked the specific variables that determined whether the shock would be temporary or structural, and who made decisions based on the full range of scenarios rather than anchoring on either the most optimistic or the most pessimistic outcome. The mechanism in the current cycle is clear and well documented. The Strait of Hormuz closure removed 20% of global oil supply. The resulting energy inflation is building into broader inflationary expectations. Those expectations are keeping Treasury yields elevated. Elevated Treasury yields are holding mortgage rates above the level that was prevailing before the strikes. And elevated mortgage rates are suppressing the buyer demand that was supposed to finally absorb the years of pent-up housing market activity that accumulated through the previous rate shock cycle. Here is the final convergence of everything this breakdown has established. The single most important variable in U.S. housing right now is not the Federal Reserve's next decision. It is not the inventory data. It is not the employment report. It is the status of the Strait of Hormuz and the timeline on which commercial oil traffic resumes at normal volumes. That variable determines whether the energy inflation currently embedded in Treasury yields is temporary or structural, which determines whether mortgage rates retrace toward their pre-conflict levels or remain elevated, which determines whether the spring housing market recovers in the second half of this year or whether 2026 becomes another year of transaction volume suppression and deferred demand accumulation. Every American currently making a housing decision is, whether they know it or not, making a bet on how that variable resolves. A war that most Americans are experiencing as a news story is functioning as the most powerful force in their housing market. The chain from Operation Epic Fury to the Strait of Hormuz to the oil market to inflation to Treasury yields to your mortgage rate is not complicated once it is traced clearly. It is just not being traced clearly in most of the real estate coverage that homebuyers are consuming. Now you have the full picture. What you do with it is the decision that matters.